Hey, welcome back everybody to the Presidio Perspective. My name is Dustin TenBroeck, CFP, and I am here with the CFA of Presidio Capital Management Portfolio Manager Extraordinaire, Dave Chenet. Good to have you. And for her debut on the ones and twos, Heather B. in the background making it all happen. So we got a great show for you today. We're going to be talking about this new inflation number that's come in, what that means for the markets today, and maybe what we might expect from the Fed going forward. Do they pause? Do they continue? Do they cut? When is all that going to happen? And also something interesting going on with the NASDAQ. I don't know, it's a couple decade thing, it seems like, that's happened. Only the third time the NASDAQ has rebalanced. We want to talk about that. And then finally, we have a special event Dave Chenet is going to be putting on in a couple weeks. We hope you can attend. We're going to tell you more about that. So all of that on this week's episode of the Presidio Perspective. Let's get it going. All right. So yes, we're back here, Dave. And with Heather back here, on her debut on the ones and twos. Yesterday was actually her debut, but something happened. We did a great show here, but it was just a rough cut because we forgot to get the sound on. But hopefully you can hear us now.
We said some great things yesterday.
Yesterday was an awesome show. It's too bad you guys will never see it. No, just joking. All right. So what do we got? Let's start with inflation, Dave. It's been hot. It's been high. We've been watching it and hoping that it moderates. And it's been stubborn, but here we go. We got a kind of a low number, the lowest since March of 21?
Yeah, 28 months, lowest in 28 months.
So over 2 years, came in at 0.2.
Just under 0.2. 0.18 was the actual number.
Versus the expected 0.3.
0.3.
Okay. So, on a 1.8 on an annualized basis, we're kind of pretty near the 2% mark.
Yeah. Yeah, if you annualize that out and looking at the year-over-year number, we're right around 3%.
So, what do you think this means for the Fed? Because, there was a long time we're saying, hey, this is going to be pretty difficult to get down to their 2% mandate, which is when, Fed policy would change. They might become more accommodative, stop hiking rates, certainly, if they see inflation moderating. It's tough to argue that it isn't moderating looking at this number. But as always, that's why you're here, to help us look through the data. So what are you seeing? Is this something that we say, hey, we're out of the woods, it's over? Or is there some other stuff that we need to be thinking about with this number?
So I think a couple things. The Fed's always been really clear that they pay less attention to that headline number. They focus on a number that comes out called core PCE, which is similar but a little different. So core just means they strip out the food and energy from that headline CPI number, which the Fed feels like gives it a more directionally true number.
Just commodities are so volatile. So food prices, energy prices are going to throw things off on a month-to-month basis. So that's pretty difficult. Yeah, I get that.
So looking at those core numbers doesn't paint as rosy of a picture. We're still right around 5% on that core CPI number.
So it's the decrease in commodity prices and food prices that are leading to this decrease in inflation.
Yeah, exactly.
Wow. What else? Where else are we seeing it?
So dig into the numbers of the report a little bit. The biggest contributor to the inflation coming in below forecast was the airline travel inflation.
So the biggest drop, right? The
Correct.
Decrease, disinflation.
Right. So that came in at a negative 8%.
Oh, so deflation.
Deflation, true deflation.
Yeah, okay.
Which, those are always seasonally adjusted numbers. So you've got to take it with a grain of salt and say, okay, did something happen with that seasonal adjustment where what they're saying in the report doesn't reflect with the economic reality? And you've been on an airplane recently. Did it feel like travel had been slowing down significantly, or was it pretty packed?
It's interesting. Travel, it seemed busy, but no, the travel experiences, if you think about a year ago or just even 6 months ago, they were hell. I mean, it was horrible. I mean, there's a lot of people like getting bumped from their flights, and so it wasn't that. It was orderly, but no, it was pretty busy. But I think that's also just, I've been seeing headlines out there that, airlines are having a hard time keeping up with demand.
Yeah.
And so they're trying to get, more stuff built or planes or get access, cutting routes, doing what they have to do. So I think that they've been in a challenge. But, sometimes when you look back and you look at a lower number, year over year, I'm always saying, well, what was that number a year ago, right? Because when I'm comparing things to what was it like a year ago, just because this month is lower, that doesn't mean that, because I could have had a big spike last summer. And if I'm thinking of that pig in the python, of that travel that happened after COVID in the summer of 2022, I bet those numbers were pretty high. I haven't seen them, but yeah. I'm sure that's more of a contributor to the deflation. And again, disinflation means a lower inflation rate, right? So instead of a 10% inflation, it's a 2%. Deflation means the prices are actually coming down.
And we're talking about prices paid, right? So not only were a lot of people looking to travel, but the supply of travel wasn't as high. So the price that you paid for those tickets was pretty steep a year ago.
Gotcha. Yep. So they've done a better job providing the supply, so prices are coming down. So prices are coming down on travel, discretionary spending, which the consumer is still out there doing. What else do you see in this inflation data?
So I think it's important to note, you made the point a second ago that the headline is the number a lot of people see is going to be the 3% year over year inflation and say, hey, you know what? That doesn't sound too bad.
No.
But if you dig into those numbers and understand that a big determinant of that is going to be the base effect. Where were we a year ago versus where are we today? And breaking that down over month numbers, the June 22 number was 1.5% in that month.
June 22 was 1.5, meaning 18% annualized inflation.
18% annualized inflation.
Wow.
And that's the number that's going to drop off in the next
June
report.
2022, if I recall, was like the highest inflation data. I mean, that's really when the market, there's that first initial downturn. We're like, oh, this isn't transitory.
Yeah.
And like, okay, the Fed's going to start doing things by the end of the year. And then June came in. They're like, nope, we're going now. And they started in July, right?
Right. We were 9% year over year at that point in time.
Yeah, annualized at an 18%. Mm-hmm. So that's what we're comparing to, or like the highest rate that we really had during the height of the inflation.
Yeah.
So when they're saying it's lower, right, it's then the high, not deflation. It's not going down, right? It's just prices haven't changed too much from the highest rate of inflation that we had. So what did July of last year look like?
Was much less. July of last year was actually flat, 0.0 inflation.
Okay. So, I mean, if you add up, the last 12 months, if you take out that, 1.5, is that where are we getting closer to that 2%, or is it still stubbornly sticking at that 4.5 and 5?
It's still stubbornly sticking. If we continue at this, call it 0.2% month over month number, we're going to be at the end of the year somewhere between 3.5% and 4%, which is an improvement, right?
Yeah.
It's a long way off from the 9% that we saw last year. But is that going to be enough for the Fed to truly take their foot off of that gas pedal?
Or the brake,
as it were.
So I think that we've hypothesized, what is the Fed comfortable with? I think it's so long as you still get moderating inflation, the Fed is going to be able to say, hey, it's working. We've done our job. We're going to let this continue to ripple through the economy. Okay. And so, yeah, maybe not the e-brake, but just, come into a slow stop. And we're going to let this continue. I mean, they're not certainly going to cut, at 4.5% rates. But, but yeah, if it's coming down, I think the Fed, is able to sit there and pause. What do you think?
I think you're right. We've heard Powell a number of times come out and say, we know that what we do with the interest rates impacts the economy on, to use his words, a long and variable lag.
Mm-hmm.
Academics have kind of put that long and variable lag as 12 to 24 months. And where are we now? We're 17, 18 months into the start of this hiking cycle. We've seen the most aggressive Fed hiking cycle that we've ever seen.
Well, I think we're 12 months in, right? When did it start? Last summer?
Was it January, I think.
Wow.
Early 2022 is when it started. So we're kind of right at that point in time where, hey, rates are going to start actually having a visible impact on the economy.
Mm-hmm.
So we've seen 525 basis points in hikes, and the market is fully expecting the Fed to go again at the end of the month.
Tell me a little bit about, how do you look at the terminal rate and kind of what the Fed, how are they going to key in on that, and what's the implications there for the economy?
Yeah, I think that's a great question. I think if you look at what the market's currently pricing, they're pricing in one more rate hike and then a pause.
25 basis points.
25 basis points.
And that puts us where, 550 to 575?
Yep.
Okay.
So, and then if you look at what the market's expecting next year, they're thinking early next year, there's either going to be a combination of disinflation or slowing economic growth, job losses, enough economic pain that the Fed's going to say, okay, now it's time for us to actually start decreasing rates again.
Mm-hmm.
So the market's pricing in those rate cuts early next year. So to your point, if the Fed just maintains rates longer than the market expects, that's going to be a drag. And they're continuing to engage in the $95 billion monthly balance sheet sell-off, which will tighten liquidity and increase the monetary policy.
Increases the long-term interest rates, right? The long-duration assets.
Right. Pushes bond prices up.
Yeah. I mean, and so if you look at inflation, sticking around 3.5, I mean, and you're going to look at the 10-year, I mean, it doesn't have to be, there could be a spread. So you have a real return in fixed income, right? I mean, so rates don't really need to drop precipitously once that happens, and maybe that's being priced in that 10-year right now.
Yeah.
So you can have a 5%, coupon bond and have a 3.5%, 4% interest rate, and that's kind of a healthy economy.
Yeah, I mean, I think it's interesting, right? To your point, it's really positive real interest rates that act as the constraint to the economy, slowing down growth, and the lower inflation number that we saw today pushes those real interest rates higher.
Right.
So is that really as good of a stimulus for the markets as they're pricing in today, or is that going to slow growth?
If you look at just about every other recession that we've ever had, that's a phenomenon you've seen. Actually, is the real return with fixed income. So, I mean, so we have lowering inflation. This is something, disinflation. So this is something that we're still, part of the narrative of going into a recession, right? I mean, that's something that you're going to start to see. Right. And so, again, we're still here with a soft landing or hard landing, right? Is the Fed going to pivot in time, or, are there cracks in the ice that we can't see that, something's going to drop through?
Right.
Right. Or, probably the worst case scenario, they take their foot off the gas or the brake, put on the gas, and then we go back into an inflationary cycle,
right?
And that takes years to get through, and then we're back to Volcker in the 80s trying to stomp it out,
which is a risk I think Powell is well aware of and wants to avoid, right? He's likened himself more to Volcker.
Yeah, and I mean, that's why here on the Presidio Perspective and here at Presidio, we're, taking a more cautious stance, I think, with the markets, knowing this.
Yeah.
And so, where do you want to be as an investor, hoping that everything's okay, or, hey, that's going to benefit from some safety. I can earn 5, 6, 7, 8% and some pretty, risk off assets with higher interest rates and potential for lower interest rates in the future. So, still that fixed income part of the portfolio seems like the most attractive to me relative to where we've been over the last 10 or 15 years. With all of this, we have these higher interest rates. Now with lower inflation, you're making a positive real return on your coupon payments. You do go into recession, soft or hard landing, rates are coming down, right? I mean, and so that's going to put a buoy on your fixed income prices down in the future. And then have something in the portfolio really that is like, hey, if we have this sticky inflation for long and you need to earn something in the meantime, well, market volatility, goes in this trading range, as we've seen and will continue to see. I would be of the camp that we're on the top side of that trading range right now, and I'd be, picking my moments to rebalance, which is kind of a segue to our next part of this podcast. But, what are you going to do? So make sure that you have some interesting things in the portfolio. I know that we like bank loans and other asset classes like that in a soft landing should do well. That pays you pretty well in these higher interest rate environments. So anything to add to that?
No, I think you nailed it. I think the only other thing I'd add to that is, hey, are we going to go back to the 0% inflation, 0% interest rate environment that was so good for the growth side of the market a number of years ago? Hard to price that in for me right now.
Yeah, even if, where do you want to play it? So, when you look at small cap, for instance, right? I mean, that's something that has been in essentially a 5-year bear market, right? I mean, we've on average, I think, look, if I look at the index here over the last 5 years, we've gone about 18%. It was 15% yesterday, big move yesterday, but or 16% maybe. But so you're talking about roughly 3% annualized rate of return.
Which
over
has
the
that
last
kept
5
up
years
with inflation after the 9% number that we saw?
Versus more like 10% on the S&P, right? Over the last 5 years, 10, 11%. So, you're in this asset class that has the bear market that, has likely the less drawdown, right? In that scenario, since it's already kind of been priced in. And also is usually the first mover out of the recession. Right. Yep. I mean, that's usually your first, kind of swing coming back in the recovery period. So anyway, different things to look at, but, rebalancing your portfolio during these times is important. The S&P sitting at almost 4,500 today, kind of big move so far this year, and a bigger move in the NASDAQ. So tell me what's going on with the NASDAQ. Tell them what's going on with the NASDAQ.
So put it in a bigger term perspective, right? Had a really bad year last year. Was down, NASDAQ down 30% last year, or more than that. Was it 40% last year?
I won't argue that. It sounds good.
Yeah, right around 40%, I think. And has bounced back this year, right? Was very oversold coming into this year. So we've seen a really attractive bounce back in the NASDAQ. But one of the concerns that we had going into 2022 was we were in this really top-heavy market, right? This market that was dominated. Back then we called them FANGs, the Facebook, Amazon, Netflix, Google. The terminology has changed a little bit. The market's calling them the Magnificent Seven this year, which will include NVIDIA's in there.
Microsoft, Apple, NVIDIA, right? Amazon, Meta, Google. I think that's it.
So those 7 stocks have been the biggest contributor to growth this year by far and away.
And now make up more than 55% of that NASDAQ 100, right? So 55% are in 7 companies. Top 5, I think, are what? I guess 50.
Right.
46, something like that.
Right. 46%, 47%.
Okay. Yep.
So what we saw from NASDAQ, the index provider, they came out and said, hey, this is a market cap index, but it's a modified market cap index. So we retain the right to, if the index gets too concentrated, we'll deviate from those market caps to reduce that concentration. So they're taking action to reduce those constituents, the weighting of those constituents within that NASDAQ 100 index.
It's interesting. So just with the top 5, or do we know yet?
They released the official weights on Friday, so we'll know more then. But definitely the top 5, probably
this Friday,
the top 7.
They released it. Okay.
Yep, this coming Friday. What is it?
So maybe by the
14th?
time you're listening to this podcast, those official weights are out. So essentially, they're going to be. Let's look at the top holdings. Well, we know the top 5, right? Microsoft, Apple, NVIDIA, Amazon. I wonder what they do with Google, because, there's 2 share classes, right? So is Tesla 5 or is Google 5? Google would be 4, actually. Anyway, okay, so very interesting. So you saw a big move, actually, in the Qs yesterday, the announcement of that, and the Qs is a term for an ETF that tracks the NASDAQ 100. so when you look at that, there's a bit of a sell-off in some of those top companies, because essentially what's going to happen is these index funds that own this are going to sell the top 5 companies and buy a lot of the other companies. And these are other companies that right, in the index. So Qualcomm, Intel, T-Mobile, Pepsi, Costco,
And not only that, but the growth managers use that index as a benchmark, right? For those managers, they don't want to be too overweight those names, so they might use this as an excuse to trim as well.
So let's just talk about what a phenomenon this is and what's going on, because look, you've seen really lofty valuations on some of these big names. Okay. Apple's sitting at $3 trillion, Microsoft as well, right? Bigger market cap than Apple. And so, and then Nvidia, right, is trading at what, 42 times sales, I think was the last trade, right? Isn't that what we saw?
Yeah, that sounds right.
42 times sales, 56 times forward earnings. 56 times forward earnings, 228 times earnings. So, this is kind of similar to when you saw Cisco in 1999. So the last time the NASDAQ's done this twice before, right? Mm-hmm. The first time was in the beginning of 99, right? Right after this tech bubble in the late 90s was running. And the biggest companies back then in the top 15, by the way, there's only 2 companies in the top 15 today that were there in 99. You know what those were?
Microsoft.
Microsoft.
And?
The other.
I don't know. IBM?
Cisco.
Yeah.
So Cisco Systems is still in the top 15. Still hasn't achieved the value, the market cap that they were valued at 25 years ago. Okay. So just know when you get these lofty valuations, you look at these companies and think of Microsoft. What did Microsoft do for like 18 years? Nothing. It was a dog for like 20 years. Who wanted to own Microsoft in the early and mid 2000s? Nobody was talking about it, right? And they had to really kind of battle through and restructure. And now again, they're the largest company. So, gosh, we've seen this before and before, again and again, guys. I mean, this is just something. And then when an ETF, an index provider, not an ETF, an index provider, mm-hmm. right? They don't even create financial products. They're just like, our index is overweight these names, which, by the way, it's been for a while.
Yep.
For them to take this measure, when they've done it before in history, we know how that's played out.
Yep.
The NASDAQ lost, 89% in 2000 to 2002. So, look, you have volatility in these assets. So, when they are decreasing the weighting to these companies that trade at pretty big valuations, you still got Tesla at 80 times sales and 80 times earnings. Still 12 times sales, which is pretty crazy. You get these valuations and just know there's a lot of economic sensitivity. So, what does a good long-term investor do, right? I sell the things that win and I buy more of the things that haven't won so much, that are undervalued. Maybe some of these other names in this index, maybe some of those small cap stocks we were talking about, maybe something overseas. So some of these things that haven't had that experience and that growth and appreciation, it's very difficult to be a good long-term investor and do this. But when an index is doing it, I would definitely take notice, right, of what's happening. This isn't a money manager making these trades. This is just an index provider making this call. Pretty something I would pay attention to if I was an investor in some of these growth stocks, which just about all of us are. In the last 3 years, the S&P has beat the NASDAQ. Did you know that?
I did. It's hard to believe, but looking back, it's true. I think 3 years ago, it was hard to do anything but buy those tech stocks, even though the valuation looked a lot better outside of tech.
Yeah.
So even with the catch up we've seen this year from tech, still think we're in that S&P value small cap period of outperformance.
Yeah. Pretty interesting.
Yeah.
Well, we're going to talk a little bit more about what's going on with asset allocation. Well, a lot more about what's going on with asset allocation. You got a really special guest lined up for an event that we have on Wednesday, July 26th at 3 p.m. So get out of work early, log off, or, turn off your phone. Join us at 3 p.m. on Wednesday, July 26th. So who do you have joining us.
We're really excited about it. We've got a guy named John Towsley. John's a managing director with Goldman Sachs Asset Management. John works on their asset allocation team. So he and his team advise institutional investors, portfolio managers, sovereign wealth funds about how they should think about their asset allocation within their portfolios based on what's going on in the economy, what's going on in markets. I've had the opportunity to talk to John a number of times. Really interesting, really smart, really entertaining speaker. So we're going to kind of pick his brain on where we are in this economic cycle, how this relates to other cycles, right? It's been a while since we've seen this true recessionary type environment. We've got to think back to 07, 08, 99, 2000, late 70s, early 80s to kind of understand what that's like. So really interested to pick John's brain and build some strategies to see what works in that kind of environment.
I think it's just so timely. In the 90s, our clients remember these. They remember 2008. They remember 2000. They probably don't remember the 70s as much, right? There's still recessions in there in the mid and early 90s that were pretty challenging for a lot of people in business, real estate, and stagnant growth in portfolios. We've seen inflation, high mortgage rates. We remember this stuff, and a lot of portfolio managers in the late 90s, right, were getting lambasted for being conservative, right? If you weren't just buying these growth internet stocks, no one was going to go with you, right? It's kind of similar to 2021 and Cathie Wood and all of that kind of stuff. So it seems like we're seeing a lot of that here early on this year too. The first half of the year has kind of just been, again, back to growth. This AI bubble has been creeping up. That's all that everybody could talk about. But what happened in the late 90s, and you went through that and you lost just massive amounts of money, or many people did who were investing at that point. Completely wiped out and having to start over, right? And what did a lot of them do? Unfortunately said, oh, the stock market's rigged. I'm going to go into real estate, and then went off the cliff in 2008. There's just a lot of investors that go and chase the next bubble and the next thing because it's going up, and things that are going up. Well, I don't want to be in the thing that's going down. I want to go buy the thing that's been going up while I've been going down. And gosh, we just see time and time again, oh, I got out of this and I went into, growth stocks, or I went into value, or I went into Bitcoin, or I'm going into AI, and whatever it is, if you just keep chasing that shiny object. So just look at the data and talk about where's your opportunity, where is the risk, and having Goldman Sachs advise us on their portfolio allocation across institutional managers at Goldman Sachs, I think is going to be great for our listeners to hear. So thanks for setting that up. I'm going to be participating there with John as well. So I'm looking forward to it.
Yeah, we're really excited.
Awesome. Well, good. So we got some good news on inflation, some things to pay attention to from our friends in NASDAQ and what they're doing and how we might want to think about that when it comes to rebalancing our portfolios. And we hope to see you on June 27th on a webinar live. Q&A is going to be on. Bring your questions. We're going to send you invites out here soon along with this podcast. So make sure to register and bring your questions. You will be able to submit them in advance. Anything that you want to ask Goldman Sachs about what you should be thinking with your portfolio, this market, recession, etc. So anyway, Dave, thanks for joining me today. Heather, good job on the 1s and 2s today. Hopefully, we'll see if you could hear us. If you could see us, then she did a good job. So, all right, we'll see you next time at the Presidio Perspective. Be well.